Welcome back to the channel. Today we're diving deep into the essential areas every investor should understand beyond just market capitalization and financial reports. You see, too many people get caught up in the hype of a hot stock tip or a flashy headline number, but true investing, the kind that builds lasting wealth, requires you to look beyond the surface. We're going to break down those barriers, cut through the noise, and equip you with the knowledge to analyze companies like a pro. Think of this as your crash course on becoming a more informed, confident, and successful investor. We're going to cover everything from understanding a company's business model and competitive edge, to deciphering industry trends and evaluating management teams. Because remember, when you buy a stock, you're not just buying a ticker symbol, you're buying a piece of a business. So buckle up, grab your notebooks, and let's unlock these investment secrets together. Let's get started. Before you invest in a company, understand how it makes money. What products or services does it sell? Who are its customers? What's the pricing strategy? This is the foundation of a company's business model. Profitability today doesn't guarantee future success. Look for a competitive advantage. What sets this company apart from its rivals? Does it have unique technology, a powerful brand, or a cost advantage? Companies with a wide moat have a durable competitive advantage. Think Apple or Amazon. Check the company's official website. Look for an About Us or Investor Relations section. Annual reports and earnings call transcripts are valuable. Understanding a company's model and advantage is like inspecting a car engine. Ensure the engine is sound for the long haul. Even the best companies can be swept away by changing tides. That's why it's crucial to understand the industry and market trends impacting a company's future. Ask yourself, is the industry growing or shrinking? What are the key drivers of growth? Are there any disruptive technologies or changing consumer preferences on the horizon? For example, the rise of e-commerce has been a massive tailwind for companies like Amazon, while traditional brick-and-mortar retailers have struggled to adapt. To stay ahead of the curve, dive into industry reports from reputable sources like IBISWorld, Statista, or Forrester. Analyst reports from firms like Gartner and IDC can also provide valuable insights. Don't forget to check out a company's SEC filings, particularly the management's discussion and analysis section of their 10K report, where they discuss industry trends and risks. And of course, stay informed about relevant news and developments from reputable financial outlets. A company is only as good as the people running it. Evaluating the management team and corporate governance is crucial. Look for experienced leaders with a proven track record. Do they have a long-term vision? Are they shareholder-friendly? Corporate governance guides a company's operations. Look for transparency, accountability, and ethical behavior. Start with the company's investor relations page. The proxy statement provides details on executive compensation and board structure. Check LinkedIn for management team's experience. Employee reviews on Glassdoor offer insights into company culture. Now, let's talk numbers. Valuation metrics help you determine if a stock is overpriced, undervalued, or just right. One of the most popular metrics is the price-to-earnings ratio, which compares a company's stock price to its earnings per share. A high price-to-earnings ratio could indicate that the market is expecting strong future growth, while a low price-to-earnings ratio might suggest an undervalued opportunity. But don't stop there. Consider other metrics like price-to-sales, price-to-book, and debt-to-equity ratio to get a comprehensive view of a company's financial health. You can find these metrics on financial websites like Yahoo Finance, Google Finance, and FinViz. For more in-depth analysis and comparisons, check out platforms like Seeking Alpha and Morningstar. Remember, valuation is an art as much as it is a science. There's no single right answer, and it's essential to consider the company's industry, growth prospects, and overall market conditions. Every investment comes with risks. The key is to identify and understand those risks before you hit the buy button. Companies are required to disclose material risks in their SEC filings, specifically in their annual report, Form 10K, and quarterly reports, Form 10Q. Look for a section titled Risk Factors or Management's Discussion and Analysis of Financial Condition and Results of Operations. Pay attention to anything that could impact the company's future performance, such as competition, economic conditions, regulatory changes, or litigation. You can also glean insights from company earnings calls, where management typically discusses challenges and uncertainties. Press releases and news articles can also shed light on potential risks. Remember, risk tolerance is personal. What might be a deal breaker for one investor could be an acceptable risk for another. The key is to be aware of the potential downsides before you invest. Want to know what the people in the know are doing? Keep an eye on insider buying and selling activity. Insiders are company officers, directors, and major shareholders. Their transactions can signal confidence or concern about the company's future. Track insider transactions through the SEC's EDGAR database or financial websites. Look for patterns, especially among multiple insiders. Consider institutional ownership too. Large organizations like mutual funds and hedge funds manage vast sums of money. High institutional ownership can indicate confidence in the company's prospects. Find this data on websites like Yahoo Finance and MarketBeat. Insider buying and institutional ownership are just pieces of the puzzle. Consider all information before making investment decisions. In today's interconnected world, news and public sentiment can spread like wildfire, impacting stock prices in the blink of an eye. Stay informed about company-specific news, industry trends, and macroeconomic events that could affect your investments. Reliable sources include Google News, dedicated financial news websites, and reputable financial publications. But it's not just about the news itself, it's also about how investors perceive and react to that news. This is where sentiment analysis comes in. Social media platforms like Twitter, X, and Reddit can provide valuable insights into investor sentiment. Are people bullish or bearish on a particular stock? What are the key drivers of that sentiment? However, be cautious of relying solely on social media sentiment, as it can be easily manipulated and prone to hype cycles. Remember, news and sentiment can be powerful drivers of market movements. Stay informed, be aware of the prevailing sentiment, but don't let emotions cloud your judgment. Legal and regulatory issues can make or break a company. That's why it's crucial to stay informed about any legal proceedings, regulatory investigations, or compliance challenges that could impact a company's financial health. The SEC's EDGAR database is your go-to source for regulatory filings. Pay close attention to any disclosures related to lawsuits, investigations, or regulatory actions. Companies are also required to disclose material legal proceedings in their annual and quarterly reports. Look for a section titled Legal Proceedings or Commitments and Contingencies. You can also stay updated on legal matters by following company press releases, legal news websites like Law 360 and Bloomberg Law, and industry-specific publications. Remember, legal and regulatory issues can be complex and time-consuming to unravel. If you're unsure about the potential impact of a particular issue, it's always best to consult with a qualified financial advisor. And there you have it. These are the key areas you should understand to make informed investment decisions. Remember, investing is not a get-rich-quick scheme. It requires patience, discipline, and a commitment to continuous learning. By going beyond the superficial metrics and digging deeper into a company's business model, industry, management, risks, and more, you'll be well on your way to making smarter, more profitable investment decisions. Don't forget to like, subscribe, and hit the bell icon for more insightful content. See you in the next video.